Good morning, everybody. It is Friday, March 19th. We got a big show today. We got Todd, Bubba Horwitz joining us. Really excited to have Todd. He always got a lot of great hot takes. We found out this morning that the Fed is not going to extend the SLR. Nike put out earnings last night. They weren't so hot. Apparently, the ports are really backed up. We've been hearing that from some of the small cap names here in Canada. The TSX welcomed a new IPO this morning, Payfair. Maybe we'll get into all that, but really excited to have Todd on. So buckle up. Let's get started. Todd, thanks so much for joining us today.
Steve, it's great. It's great to be with you. I'm excited to be and spend some time with you guys today. I'm looking forward to a lot of fun.
Yeah, we really appreciate you taking the time to come on here. Maybe I'll set the screen that way. Typically on Friday, we usually get the guests that are the most exciting for us because I don't know why it works out that way. We had Rick Rule on the other Friday and a couple other ones that are just, for some reason, it's just whenever we get someone. Lobo Tigre, I think the Friday before that. So now we got Bubba. It's really, really exciting to have you here. So let's get started right from the news that sort of just hit the wire this morning about the Fed announced that they're not going to extend the SLR. What's your take on this?
Well, I mean, listen, I think the Fed is first of all, the Fed is totally lost and has no idea what they're doing. And I think as you're going to see eventually, they're going to create this major meltdown because they don't understand the market function. They don't understand how markets actually work. And they believe that by, continuing with some of their stimulus plans and some of the other stuff, that they're actually doing good when they're just really doing enormous harm to the market structure, to the system, and certainly to the taxpayers. Because at the end of the day, who gets to pay this bill that they're making right now? We do. And it's a ridiculous when you watch them try to operate, and instead of letting businesses do what they are, and if we operate, if you and I operated like the Fed lets the banks operate, we'd be either in bankruptcy court or jail. But yet they let the Ponzi scheme continue to go on, which to me is a much bigger problem. And this will always, as it always has since the original bubble builder Alan Greenspan started, will lead to a disaster. When, nobody knows, but it will be a disaster.
So the big talk whenever I throw on excuse me, the big talk whenever I throw on CNBC is the 10-year. That's all we ever hear about, and it's almost like they do a round table where they just say, okay, 10-year, it went up 20 basis points. What's everybody's take? And then almost everybody says nothing of any value. Now I know that you're somebody who follows this stuff closely. So I'm going to do the CNBC. I'm having a hard time talking this morning. CNBC thing and ask you what's your take on the 10-year for us as equity traders that are generally on the long side? How concerned should we be by the 10-year going up?
I think you should be very concerned because here's what you're having right now. You're having the bond market, the fixed income market, which is it's the biggest market in the world by 10 times. You can add up every equity index worldwide. When it comes to fixed income, it's the biggest market that there is. And they're the one market that can actually fight back and battle with the Fed. And they're telling you that the Fed is wrong. Okay. If you look at a chart of the 10-year that's gone from 0.25 to 1.76 today, okay, and you look at that model, the bond traders are telling you, the Fed, you're wrong. You have to quit with the easing. You have to quit with the printing. You've got to raise the Fed funds rate because all that's happening right now is the banks are making a fortune because interest rates at the retail level are going higher, yet they're still borrowing at zero, and it makes absolutely no sense. And that's why that's why it will eventually create this market meltdown because they don't understand what true equilibrium is. Because interest rates should be probably 4 or 5%. Because if you look at a lot of the other lenders besides the banks, the peer-to-peer lenders, the franchise lenders, they're getting 4, 5, and 6%. Okay, so it's not a hard problem to get. If the Fed would step out one time, okay, and let the free markets work and let asset classes price themselves, we would get real true prices versus the ridiculous model we have now. And if nothing proves it greater than housing sales that are at record pace, and yet people aren't even working and they're buying homes.
Mm-hmm. And it's interesting you say that, because that's something I got tremendously wrong. I thought real estate would have gotten crushed during all this monetary stimulus, and we've got, what was it? 25% of the money supply has been increased, but we've seen so many people just aren't working right now. I would view as a very risky time to go and take on a ton of debt and leverage. And it sort of brings me to my next question, which is, I'm sitting here in Toronto, where housing prices are they're going crazy. You've almost got to be a doctor or like a high-end corporate lawyer to be able to afford a home. Now, I look at a lot of my friends and, my peers that have regular jobs where, they make a solid living, and they're just totally priced out of this market. And I wonder, like, what happens here? What are young, hardworking people supposed to do as they watch asset prices rise further and further out of reach, and they're just sitting there,
twiddling their thumbs?
Yeah, what do they do?
Well, I mean, and there is your answer to the problem. What they're really doing here is they're allowing the wealthy to just get a lot wealthier because, of course, they've got access to the cheapest capital. They understand how to put it in play and where to play it, and they can absorb some of the risk. You take a look at, for example, Warren Buffett. Okay, everybody talks about what a great investor he is, and I'm not taking away from him that he's a good investor, except how many of us could buy Goldman Sachs at 120 and watch it go to 10 without batting an eye? But of course, he always gets a special deal with some preferential treatment. So they're really destroying the overall system of what we grew up here as, and they're taking people and pricing them out, because the real price discovery model of what a home is worth is really, what is the interest rate? How much is it by the month? Can I pay the monthly payment? And that's how people judge, which is why housing, like in Nevada, okay, now I have a home in Nevada. I bought one 16 months ago. I made 40% on a house in 16 months. You know how ridiculous that is? I just bought a new house, a brand new house, new construction. And guess what? I can sell that for 40% in 3 months. That's ridiculous. But that's why it will always lead to a general meltdown when it's all said and done. Okay, that's where they're heading, because again, they refuse to let the markets themselves work, which gets people sell for overvalue, and then they go buy for overvalue. They get so leveraged up that eventually the wells run dry and the money runs out, and they all have a big meltdown. And that's what we're going to see. Same as 08. This is almost identical in circumstance.
So my question for you on that would be, doesn't it make sense though that the Fed's going to step in? They're going to create some new sort of Operation Twist. Who knows if they actually sell the short term? They probably just print money and just buy the long term. Is that the likely scenario that we're looking at in the short run?
Probably. I mean, look, they should call Chubby Checker to do the twist, because it's a ridiculous, another bad program that they have created. We cannot continue at this pace, because, if you understand the fiat currency system, every central bank around the globe are a bunch of crooks anyways. They're all working on trying to get their dollar down cheaper, and it's a race to zero, which again, I think eventually will lead to a global currency. And I think, the euro currency, which was the first experimentation of multiple currencies in one, I believe that you're going to see this globally. And this is where many of the issues come into play, because you can only print for so long. And for example, the stimulus packages in the United States, they're worthless. They don't create jobs. They don't create growth. They create nothing. Okay, but debt. And that's that we continue to assume debt as a government, which means that we, the people, know that there's a bigger tax bill coming. And you can bet that Joe Biden, who said that, he'll be working, people that are over 400,000 will be paying more taxes. You can bet that they'll drop one of the zeros. It'll be those over 40,000. because look, you cannot finance what they're doing with how you run the system, and it makes it backwards, which again takes me to my original point that the Fed is actually clueless to how a market actually functions. Now, they may be very smart people, but using models from 100 years ago are incorrect because they don't count, inflation. Everybody hears, you keep hearing Jerome Powell every meeting. Well, we're trying to meet our inflation targets. Ask a farmer about the inflation targets. Ask any human being. When you shift from a manufacturing economy to a service economy, food and energy means something. But of course, the inflation numbers they're using exclude food and energy. So you tell me where the logic is there.
Mm-hmm. So this brings up sort of the question, and I don't know how much you want to get into this, and how much of it you just get into this for your subscribers. But how do you position your book here? Are you looking towards value stocks? Are you positioning yourself in precious metals, crypto? What's the playbook?
All the above. Okay. Now we run, I don't handle anybody's money personally. What we run is we run some portfolios. We have a proprietary algorithm, but we have a number of different models in which I run. And I trade them all myself so I can speak to them, and I'll tell you exactly what they are. We run, either futures or equity portfolios. Now the equity portfolios are based on the ability to use options, creating a synthetic stock and using leverage, but we're going to play the trend. Now we're always with the longer term trend. We don't sell tops. We don't buy bottoms. We are looking to catch long moves and get the meat out of the market, whether it is the futures market or the equity market. However, my core investments, my big money, is always hedged because we also hedge our portfolios. I have designed a mathematical model that uses underlying options to take care of a portfolio. And we use a couple of ratio spreads, but we've got everything is done by numbers and percentage, not opinion. So my people, we're always buying equities. We're always investing more, and we're actually adding, and our software actually adds automatically. So for example, a year ago, when we were going through COVID and the whole market was falling out of bed and everybody was selling, my people were all buying. Why? Because we were hedged and protected anyways, and we're hedged to a mathematical certainty on a number, so we know what our exposure is. And the key is to remember one thing: as much as I may say the market's going to melt down and there's going to be a problem, which there will be, but we all also know that history says the markets go up 8 to 8.5% year over year. So what you need to find is you want to find some good, solid companies that you believe are going to be in business 10 years from now and invest there. As far as cryptos, I'm a fan. I'm not a huge investor. As I tell my own members, I own cryptos. I'm a believer. If I lost it all tomorrow, I would not lose 1 minute worth of sleep. I don't have that much in. I have enough in to make it worthwhile, but not enough to hurt me if I'm wrong. And I wish I was like one of the kids that worked for me, because he was a believer and he bought $20 a week starting in 2010 of Bitcoin. Of course, he's retired, living somewhere in Mexico now. But I think the crypto is a real, and it's spectacular. If you remember Seinfeld, they're real and they're spectacular. I think that cryptos are certainly the libertarian currency. And I think that is why you're seeing, because people are tired of the intervention and the basically offering secondary issues on your currency and making the $100 in your pocket worth less every minute of the day. So you're seeing a much bigger picture. The actual crypto market has doubled in value, besides obviously Bitcoin going bananas, but all of them have gone up. And I think when they sort through it, I think there's 8,750 cryptos. When they sort through them, I think there'll be 4 or 5 that will be legitimate, will be real. And I think that's where we're going to find out where the Fed stands. And, Ripple tried to work with the Fed 5 or 6 years ago, and the Fed wanted nothing to do with them. But the actual system itself is so much cleaner, using cryptos for transferring, for all those things. They're going to have to be forced to do something, but I think they'll find some way to at least have a thumbprint on it. I don't think they can ever totally control it unless they stop vendors from taking it as payment. But as far as the actual operation, I don't think they can do anything.
So this kind of brings me to my next question. Is a common talking point is when we're talking about precious metals, gold, obviously one of the biggest things that drives the price is sentiment. If people think that gold's going to go up, they buy it, just like Bitcoin. The common talking point I'm hearing from a lot of gold bugs these days is what's really holding back gold is U.S. equities. That's really what they're competing against. But if we're going to use the sentiment argument, and money's flooding into Bitcoin, it does appear to be having some sort of an impact, because all these millennials who are sort of speculating, they're seeing one asset class, generate tremendous return, and the other kind of sit flat here, at least for the last 6 months or so. What's your take on gold, and what ultimately is going to drive it moving forward?
I'll give you my double take here, Steve, because it is worth talking about, and since I do write about it every day as well. But right at this moment, I personally, on the board, through paper, through futures, whatever, I'm short gold, I'm short silver. We stopped shorting platinum because it's not liquid enough for all of us to trade. But I would be short that as well. Okay. But again, I'm talking about as a trader, which can be, a week, a month, 6 months. I don't know. Okay. We never know when, but we're using an algorithm that gives us the signals that switches it over. But from a long-term investor standpoint, I'm a buyer of physical metals all the time. Okay. I buy on a regular basis, X amount of dollars of gold, silver, and platinum. And right now I'm heavily dominating buying platinum because I think platinum is on sale at the prices where we're trading now. Okay. But, I think over time, gold, silver, and platinum will be dramatically higher at some point. So you have to remember what your perspective is. And as a trader, I am short across the board. And we were long all the way up to the highs, and obviously get short on the way down. We didn't get short at the top. We get short on the way down. But we were long all the way in through those highs, and we will be long again. When? I can't tell you. I mean, right now, if I was telling you, I'd say 1750 is a pretty key area. And when we failed the other night at 1754. So, but overall, I'm a big believer in the precious metals, and I'm always a buyer. I'm always an owner. I'm always taking delivery. But when it comes to trading, I will trade either side of that market.
Okay, so how do you play precious metals? Are you playing the commodity itself, physical futures? Do you play with any of the miners, exploration? What's your strategy?
Okay, great question. Usually for me, I use the gold futures at the COMEX, okay, to be long or short, for my trading standpoint. In silver, I use also the futures market. I don't get involved with a lot of the miners. I'd like raw commodities to deal with. Now, I will use on occasion, I'm long term, I'm very bullish silver, right? I mean, I've been saving silver, believe it or not, since 1964, when they stopped using silver quarters, the silver coin. So every time I found them, I put them in a coffee can, and I've got coffee cans of silver that I've been saving, for 40, 50 years almost now. But I think that, I will use SLV once in a while if I'm going to the long side of the market, because I can create a highly leveraged position in SLV, okay, without exposing myself, like through the futures market. So if I get a buy signal, I will create, not only will I buy some futures, but I will create a much bigger position through SLV. And again, that's because I can do it with a lot less risk, the way I can design the trade. But I never use it to the short side because it really doesn't move enough at these levels. $25, where's it going to go? But I do see silver exploding again someday. When that day comes, I can't answer, but I do believe that it is going dramatically higher at some point. I think gold is too. I just think that we have to be patient, and you have to watch the market and understand what the overall trend is of what you're trading. And right now the trends are down. Now, again, if you're an investor, that you should hold on to them and forget about it. Because if you're trying to trade physical gold, you should have your head examined anyways, because it's too hard to buy and sell between costs. So if you're using paper, okay, then you should be with the trend for the short term. And certainly I will say this, I would never be a long-term investor in like GLD or SLV or any of those, because I don't think there's enough gold to measure what they've got outstanding in paper. Okay. So when I'm buying, and I'm buying as an investment, I am buying the physical metal from a dealer, okay, and I'm taking delivery and I'm putting it in my safe.
Okay. So here at we run a site called the Deep Dive. We're mostly focused on small cap stocks. We're sort of more bottom up focused. So we look at balance sheets, income statements, cash flow statements, accounting notes, all that fun stuff. And this is why it's great for us to have someone like yourself on. Is you look at that sort of macro picture and where capital's flowing. What's something that you think that small cap investors ought to think about in terms of what's going to drive risk over the near term?
Well, I got news for you. I'm a big lover of small caps, anyways. I mean, I'm a big fan of the small cap industry because it's much less affected by global events. I think when you're looking at small caps, you have obviously tremendous potential for very big returns versus what you'll get from the S&P 500. And I think you just have to do your due diligence. I think you have to do your homework. And you talked about doing balance sheets. Now, I am not personally a fundamental trader. I'm a technical trader. But when I'm buying something for myself, for my retirement, or for whatever, I'm going to make sure the fundamentals are good enough that I think the company's going to make it. But I will only then purchase it based on a technical analysis at a later point. But first, I have to identify that I believe in the company. And I think by what you're doing with the balance sheets and everything else, but I'm a huge fan because that's a great growth industry. As we've just witnessed in the last year, the Russell itself, the Russell Index, which is the small cap index here, was getting clobbered, and I thought it would never make new highs again. Way back when, and because all the other industries were making highs, and suddenly the Russell surpassed everybody and is the biggest gainer in the last 12 months. It continues to be strong. Once again today, even again, the futures are up another 292 points as we speak right now. Okay, in a market that is 10U at best, but yet again, it will be much less affected. And I think small caps is what the NASDAQ used to be. Okay, because the NASDAQ is, although it's still wild, is ballooned. And I think you can find some great values and get some huge returns by doing your work properly in the small caps.
So do you have any sort of variables? You wake up every morning, you look at your screen. What are the first 4 or 5, or maybe the first thing you're looking at? It's Friday, March 19th. What's the first thing that trading's looking at when he wakes up in the morning?
Well, Bubba gets up at about 1 o'clock in the morning. So Bubba,
wow.
Bubba starts trading at about 1 a.m., 2 a.m. in the morning Central Time. And I'm looking at the futures to get a feel for direction of the markets. Okay. And then, of course, I not only do I trade futures, but I carry an extraordinary amount of option positions as well. And of course, today is a triple witching expiration, which in terms of what I know, triple witching is nothing because they've scattered the expirations. But what it used to be, just for those who don't know, is they used to expire currency, bonds, options, all at the same time on a Friday, okay, which caused a lot of volatility. And they've subsequently changed that. Bonds are 3 weeks ago, currencies are, and so everybody rolls early. But there is some heavy volume that will come in. But then I'm looking at, my options positions and where I want to go from here. Okay, I run the algorithms, but also I'm looking at companies that I want to put away and look to be a long-term buyer in. And every day I take a look around and I'm looking to see if there's earnings coming out, because I'm a huge fan. If I can find a company that I like, okay, and they got earnings coming out, I'm going to hope that it gets clobbered on earnings because I want to buy it cheaper, right? Because I believe in the company, so I'm not afraid to step into it after the earnings comes out. But I'm watching the chart and the price action because markets themselves will give you a very good idea of what is actually happening long before. And with today's information, unlike when I started. Now, when I started trading, we had 48 floor traders with 2 12-inch LED screens. Okay. Now everybody's got a computer that could launch a rocket from their back pocket.
I'm not even a trader, and I've got 4 screens, actually 5 screens in front of me right now, and 2 behind me. Like, quite frankly, it's overwhelming.
But again, so we go back to when news was then, there was some inside information. There is no more inside anymore. That's why the news is worthless unless you know something well before anybody else. But you'll see markets will price out things long before they happen. So what you're doing with looking at the balance sheet, looking for strong stocks that have some real great opportunities is the proper way to start. Because again, what you want, the worst thing you can do is get involved like with a GameStop. Okay. I don't understand what happened with that whole, I know it was heavily shorted, that I know. Okay. So that's going to create a short squeeze. I don't know what's subsequently happening now unless they re-short it again. But overall, their model is broken. They have no chance. They have no chance to survive unless they have some secret product, because they're a brick and mortar that sells a product that's antiquated. So where are they going to go? But when you look for, again, you want to look for things that create potential. And, whether it was Apple way back in the day or Microsoft, way back in the day, you want to look for the next of those markets that can create opportunity. And again, there's going to be some lemons in there, but there's always some lemons. So, but at least give yourself the greatest chance of opportunity to at least have a company that has strong balance sheet and baseline that is going to be in business and survive.
So let's talk about SPACs for a minute. I still haven't fully wrapped my head around SPACs with everything that's going on there and what's driving people who want to invest in these, because it appears as though deal flow is starting to dry up and more SPACs are coming online. How do you think that this is ultimately going to end? And do you trade any of these?
I don't, and I think it will end very poorly. Remember, markets are always creating markets that they can get demand out of. Okay. And so, wherever they can get money flowing, they're going to create these products out of nowhere. And I think that, like everything else, I think this ends with a big bite in the ass, because, what you've really done here is you've forced every investor into one market, which is the equity markets. And, you've taken out the elderly and you force them into equities. Now, they're not happy about being stuck in equities because, they worked their whole lives to save their money. And now they're stuck, worrying every night about what the equities are going to do. And so it will end with a bust as always. And then we'll rebuild as always, because look, as I said, no matter through all the big declines in history, the markets are still up an average of over 8%. So you have to just base it on that and adjust your risk tolerance. But to chase the shiny keys, as I like to call it, I think that's always a mistake. I think what you're doing and trying to build a baseline with real solid companies and not chasing the dream or the rainbow, because most of the time you don't end up with a pot of gold, you end up with a pot of something else. And I think you want to be very careful about that.
Mm-hmm. And there's certainly issues when it comes to trading, and and I know I have a lot of friends. They invest in one particular equity, they get quite concentrated, and then they see all these other equities around them going up, and they get a little bit, I think, sometimes caught up in the short term. But the interesting point that you bring up there is some of the elderly people that they're sort of stuck in these sort of fixed incomes bonds type instruments, and that's what they're relying on to pay for food and electricity and shelter and all that sort of stuff. Where do you think pension funds are going to go find yield if are they going to start looking into riskier assets? I read one article recently that a lot of U.S. Pension fund managers are now looking at Chinese treasuries, or I'm not sure what the term is. What do you think is going to happen here in terms of those large fund managers that have to get yield on the pension side?
I think they already are chasing equities. I think this is one of the reasons you continue to see the never-ending rally. I think now it's this point with the 10-year. We can get the 10-year back above 2%. You will probably see some money come out of equities and go there, because people, pundits love to say, well, the market outperforms the 10-year. And okay, I mean, in a real life, yeah, it kind of outperforms it, but does it really? And the answer is no, it really doesn't. Because if I take my $100,000 and buy a 10-year note, that $100,000 is guaranteed plus the rate of inflation that I've got for interest rates. Okay. And that's guaranteed by the full faith and credit of the government. Not that I agree in their full faith and credit, but it's guaranteed. Versus I can take that same 100,000 and yes, the stock market dividend is, let's say, 3.5%. However, my equity can get cut in half.
Mm-hmm.
So maybe my dividend will go to 7%, but I get half the equity. Well, people can't live like that because remember, if you're a fixed income or you based on and your earning power is now gone, you're not looking to be in these very risky assets. You didn't plan for this 30 years ago when you started to save your money, planning to retire at whatever age you're going to retire, which is why you see so many of them working like at Walmart and all these other places because they have to subsidize because they don't want to go into that base principle of money because it's got to last them as long as they live. And of course, we're living a lot longer now as well.
Mm-hmm. Okay, so I won't keep taking up a ton of your time here. You've been pretty generous.
All the time you want.
Okay. So here's a question I like to throw at people like yourself that have been a trader for years. What's this? And I don't know if you can paint me a scenario here, but what would be the perfect trade on a technical level that you would make that trade, 7 days a week or 5 days a week if it's only tradable. If you can give me an idea of the framework that you would just go, oh, I've got to play this trade. Is there any sort of like variables or things you look for that like that's the perfect setup?
Yeah, well, I mean, listen, first of all, I'm a big believer in technical analysis. Okay, and if you want to bring it down to its simplest form, I believe the market goes through three basic phases. Okay. And the birth of every market, in my opinion, comes out of consolidation. Okay. Which is actually known as the greatest time of uncertainty. Buyers and sellers keep bouncing it back and forth. And typically the breakout either up or down from that level would be a trade I'd want to make. Okay. And I'd want to jump on the trend, whichever way it happened to be going. Okay. Because again, I trade both sides of the market on a regular basis. So that's what I'm looking for. I'm watching the price action of the market. I will buy a market breaking out of consolidation. I will buy that every single time. Okay. Or sell it every single time, depending on which way it breaks.
Okay.
I will trade that pattern every single time because yes, there are false breakouts. But again, all I'm trying to do is make sure that I'm getting the right percentage of winners over losers. And of course, one thing I do know, my losers are limited to the amount that I've already assigned to them, and my winners can run forever. And I don't get out of those so quickly until we get the reverse and it changes trend. So, we've taken, stocks from, 170 to 320 all the way through, and then on the way back down, sold out. But so that's what I'm watching. We call it the phases of the market, and they're just quickly consolidation, breakout, and usually most markets will end, especially down markets, will end with what they call a blow off, which is when price and time become regardless and nobody cares. They're just got to get out. And it's, get me out at any price. And if you go back and look at 09, that's why in March of 09, I mean, I could never tell you could pick the bottom, but you knew the bottom was very close because you could see by the panic that was out there among retail traders, yet regular traders, the volatility was collapsing at the same time, which is an anomaly in itself. That's not the right formation to look at. So I'm watching that kind of action, but it would only be, again, I trade 29 futures products and I trade, besides what I own, but I trade 23 equity products at a time. And, they're all based on the same thing, but that's all using that type of formula. But when I'm investing for the longer term, I want to make sure I have a company that I believe has a potential, and then I will still use the same formula to get in. Okay. But I won't get out so fast because I'll protect that because I want to invest for the longer term. So there's a difference between trading and investing, but that pattern I will play every single time. And I will always be a seller of the blow off pattern or a buyer, depending on which way it is, because it's usually good for a pretty quick return. And then I will then readjust myself and look at the market again.
Okay. When you say that you trade the breakout, you're whatever side it breaks out on, that's sort of that idea that the trend is your friend. So if we have like sort of, I don't know if the right term is channel, where it's sort of trading in between
Yeah,
and then it breaks it on the upside, you're going long.
yeah, yeah. No, you're exactly right. We're what we're trying to do. If you remember the turtle traders, okay, we have mimicked. I know Richard Dennis pretty well. I mean, we traded together back in the '80s, and we have recreated what we think is a better model, but we're using an algorithm because obviously the biggest problem in markets is human emotion. So you have to eliminate as much human emotion as you can and be able to use something that is rule based. Because what we do know for a fact of any trade we make, okay, is we always know what the exposure or risk we are willing to take. Okay. And you have to assign your risk, but you also have to let your profits run until something changes. And the most common flaw with most investors is this: they're quick to take profit and they're slow to take the loss, which is the reverse. You need to be quick to take the loss when you're wrong. And listen, sometimes you're going to be right, but you're wrong. You got to get out and take the loss and let the winners run, because winners, strong stocks or strong, whatever is strong, will run longer than you think it will run. And whatever is weak will be weaker than you think it is. So it's easier to define how you're getting out. Once you're in, where's my exit? And it's got to be a hard exit, because if you don't, you're putting yourself in jeopardy of getting killed, because nobody ever has enough gumption to sit there and take the run and let markets run as far as they can. Now, again, I've told you, I don't sell tops. I don't buy bottoms. We will see a top and we'll be in it at the top, but we won't sell it until it breaks back down. Let's say 4 or 5%. I don't know the exact number; it changes. But we won't sell it right away, because I'm not trying to pick the top. I want to let it go until it says I'm no longer going up, and then it will reverse and I'll get short.
So you've been trading for 20 years, or
43.
for 43. Sorry,
Yeah.
In our research notes. You must look back at your 43-year trading career and have a trade you look back and say, okay, I played that perfectly. Perhaps I went outside my normal rules and I put a lot more leverage or a lot more of my account into that trade, but I read it perfectly. Is there any trades over that 43-year history that you can tell us about?
There's a few, but I give you one because it happens to be an interesting story on top of it. When I started trading, the Dow was 800. Okay, so that tells you I started in 1980. But in the meantime, it was a Friday before the Super Bowl in '84. Okay, it was the year before the Bears went, but I used to go to the Super Bowl every year, and I was all scheduled and ready to go, and we had our air flight, and I called my buddy and said, you know what, something's happening in this market. I'm not leaving. Okay, I'm sorry you guys go without me. And, we didn't have cell phones then. I had to go downstairs and I called one of my buddies who's also a trader. I said, look, Jewel, something looks funky here. I think we're going to have a huge sell-off. I walked back up into the pit, the trading pit, and there's a broker. And you can always tell if they're holding a lot of paper or a little bit. And he says, at that time, the OEX was trading at 155. So you get a basis. He goes, double puts. What's your market? And I go, half, 3/4. And he says, he gives me a sold. So I know he's got a ton. Okay. I go, okay, I'll buy 20. And he goes, 2 seconds there, he goes, double puts. He goes, I go, 1/4 a half. He says, sold. I said, I know he still got a ton. And then he says, I'll say you 500 at $1. I said, done. Buy him. Okay. That was the biggest trade I ever made at that point. Okay. Before I could write it down on the trading card, I was already selling it for $2 and $3 and $4 across the pit. That's what the market immediately turned once I bought them. So I sold the last one out at about $7. So that was, so I read it right. I was correct. And I was a benefactor of a lucky break of a broker who panicked, and I was able to take advantage of it.
That's so different than the the world that most of us are trading today, where you actually got to sort of see your opponent face to face,
right?
And you don't experience anything like that today, do you?
No, because the dynamics have changed. Remember, as a floor trader, I could see all the paper flow, which is what we were trading anyways. We didn't, when on the floor, you're not using a chart. You have no time to use a chart. I go back to when options traded in fractions, right? So we didn't have time, and you had to be able to calculate fractions and make a market for a broker if you wanted to be first and get the business. Okay. So we didn't have this type of stuff, but we did get to see the order flow. And of course, this is when I learned, you talk about spoofing, right? And everybody talks about spoofing, how bad it is. Well, everybody spoofs. It's a joke. But in those days, in the OEX pit, which at the time was the biggest pit in the world, the big bankers, I won't name names, but the big bankers, they'd send their buy broker to one side of the pit to create a buzz when they really wanted to sell. And on the other side of the pit was their sell broker who was going to bury everybody with everything after they bought it all. And, this is what happens all the time. And you don't get to see that on the screen. Now, I can see some of it, but the entire strategy of trading is different because on the trading floor as a trader, first, you're going to get the edge most of the time. Okay, on the trade, whether it was a quarter point or an eighth of whatever the number was, you'd get an edge. So you already had a built-in edge, and you knew, like, if I did one thing, if I did A, I knew what B and C were right away. So I could lock in that profit if I chose to do so. On the screen, or as a retail trader, I don't have the same margin availability. I don't have the same information to work from. Now I can see a lot of it in the price action, but it's still not as crystal clear, okay, as when you're in the actual wars of trading on the floor against brokers. And I want to remind everybody out there, you are in a competitive business. This is a competition, okay? And it's your job to do the best you can to understand your risk, your exposure, which is why you always want to identify that risk the minute you put it on, because it is a battle and it is a competition against others. Now, we can all do well, but we do know that we are fighting against, market makers and other things, even so.
It sounds like the analog today would be watching social media, right? Like something we do is if we're, in a micro cap, and we're trying to determine what we want to do in terms of stay long. We generally don't short micro caps. I've sort of got a thing against doing that.
I don't blame you.
It just, these are people's jobs and you're screwing that up unless there's really bad actors involved. But sometimes we kind of try to read the room a little bit in terms of if we're in a position, maybe we're not so hot on the stock, but we're noticing there's a lot of activity in message boards, a lot more activity on social media. We even got a website where we can see the overall view count on articles. So it kind of tells us like, okay, this stock, regardless of how we feel about it, the popularity is growing. But then even still, that's not necessarily a perfect read, because it could be, like there's these retail shareholders, they may be, the last ones to take on the baton, and they can only push it so far. So it's certainly for us. I think our analog to how you used to trade would be that we look at social media. Now, obviously, you're looking at much bigger things than we are. I'm curious, do you ever take a look at sort of Reddit and Twitter and everything to try to gauge sentiment of commodities or individual equities?
I don't, and I'll tell you why. Because, listen, I can honestly say to you that in 43 years, I've never read the Wall Street Journal. I've never looked at a copy of Barron's. And now I've got to the point where I can't take the pundits on air anymore. And I don't even listen to the news anymore. I'm strictly trading off the price action of the market. Okay. And it's very funny. You mentioned Reddit. And of course, that, what was it? Wall Street Bets, that which was actually, and I think people are going to jail over that, because I think that the guy behind it was actually a registered rep, which is against the law. But neither here nor there. That night, silver on Thursday night that week, it was in February, but whatever the Thursday night was, silver spiked like crazy. Everyone was panicking. And of course, we were short silver at the time. And I go, hey, so what? Look, just be careful, be patient. This is a panic, and there's no way they can squeeze the silver market as they squeeze the GameStop. Why? Because silver's a commodity. Number one, it's not a limited stock that has limited shares. And of course, silver spiked up on the Monday and came right back down on Tuesday. And we actually got long at that point. But my point is that I try to stay away from being influenced from anything but the price action I can see right in front of me. And that's all I care about, because I think that tells you more than the news. I think when you look at a market, okay, if you let news influence you, now you're using it to your benefit. You're saying these guys are doing X, so we're going to try to figure out how to use that information for us. But people that like watch and look for the news to help them secure a position, I figure this way: when I hear the news, I'm the 1 millionth person, and the price action has already taken place. So I'm going to be stuck holding the bag, as many often are in like Ponzi schemes. So it's just easier to let the price action dictate to me what I have to do next. And I watch a gambling show all day. I'll watch Vegas Sports and Information Network all day long.
Mm-hmm. So it's interesting. You say you're up at 1 a.m, already looking at the markets. How much does this impact your personal life? And I don't know if you want to get into that, but for me, I find like some of us are just wired differently, right? Like we're just constantly thinking about the markets and trying to look at certain scenarios, how to position our book, and just, can't shut it off. Are you able to just, if you're with family or friends and you just want to sit down and just sort of focus
No,
on that, or is that a struggle for you?
I love the markets. Okay. If I'm awake, I'm watching them, whether it be at night or whatever. Now, I mean, I'll obviously today, March Madness, I'll be watching a lot of March Madness, but I've always got the markets up. I'm watching them as where you and I are talking. I can see them right in front. I got 6 screens in front of me that I can see. And, I'm always involved watching the action. And I can go out and socialize. I can go wherever I want. And, because I can always take a peek at my phone if I'm concerned about something or I want to make a trade. But overall, again, I love the markets. To me, it's not work. To me, it's a joy to be involved. And I love to be able to pass on knowledge to others. I teach it pretty well. I mean, we actually built a high school program, and we're in 600 high schools at one point, we were donating the course to them. But of course, with all this COVID crap, it kind of killed that for a while, which is fine because it saved me a lot of money because I was paying for it. But, at the end of the day, I love to educate because I've been very fortunate, but I love the markets. And to me, there's nothing like it. And I think my family is adapted to it. It has no effect on my family. And I think my son became an advisor. So, I think that, he enjoys them as well. And again, I'll go out and play golf. I don't have to worry about it. I do many other things, but I always have access, to what's going on. And if I'm going to be out of touch, I have somebody watching for me to inform me if this happens. I want to know about it, and that's it. And that's me. But I'm watching markets from 1 a.m. until I go to bed at night, which is either 7, 8, 9, or 10 at night. Okay, and I have no problem with it. And it's like I said, it's very enjoyable for me because to me it's not work, it's a passion.
Yeah, for same here. My issue is just shutting it off and focusing, and that sounds special. Like I've got a 4-year-old son, and I hope that he loves the markets as much as I do, and it's something that we can connect over the way that I connect with my dad, and we talk about Pittsburgh Steelers football. That's just.
I hope your son connects with you on that too, because I think it's a great. Listen, there's no better place to be in history than equity markets in general. Okay, especially if you understand what you're trying to do. There's nothing has created the overall yield. Okay, and I think it's a great topic to be with and to be able to talk about, because most people don't understand markets, how they work to begin with. And at the end of the day, if you listen to an economist, most of them are clueless as well, because they can tell you what happened. A year from now, they'll tell you what happened today and why it happened. I don't want to know a year. I want to know now. Don't wait to tell me you're in a bubble. I want to know now. And I say that we are in a bubble right now. Now, it may not pop tomorrow. It may not pop for a year. You cannot dictate when a market's going to change. Okay. All you can do is keep paying attention to the factors of what makes markets work. Okay. And that is price discovery and price action. And once you can understand that and you can put the phases of the market to work, you will understand exactly where these markets are and what they expect to do. And just last week, when it looked like we're going to break down and the tops might have been in and we were short, we reversed and got long again. But at the end, you could see once they failed to make a lower high, they were going to go up and make new highs. And that's exactly what has happened. And, those are things you just have to learn by watching and observing. And just a quick tip for listeners out there, if you like the markets, watch a very short-term chart, like a 1-minute chart, not to trade off of, but to learn from, because I'm a big believer in what we call universal price. All charts are the same, all patterns repeat themselves, okay? So if you just look at a 1 minute, all it does is a 1 minute chart gives you 5 years of data in a 24-hour cycle, okay? And those same patterns you see in 1 minute appear in the 5, 10, daily, weekly, and they'll all appear the same way. So understanding that will help you immensely if you learn how to read the overall price action in the market.
Mm-hmm. So Jay and I got into it recently over Kathy Wood made a comment that when we were trading sub 100 basis points on the 10-year, that the market hadn't fully priced it in. I tend to believe that. I think that the markets were going to keep going higher as long as it stayed there. Now let's just assume or go through the scenario that we do get some form of operation twist or yield curve control, and they try to knock the 10-year back down to that kind of level. Do you think that equities just totally rip higher?
No, I think the equities are higher and they will continue to move higher. I think the next big rip, in my opinion, will be down. Okay. Now, again, it doesn't mean we won't continue to drive higher, but the next real rip is going to be to the downside. And, again, we can go up, and hell, we can go up to 40,000 a Dow. I don't know. There's no number I could ever put on it. It's going up until it doesn't. But if you've noticed, we haven't seen a lot of the big rips unless it was immediately following a big sell-off. So I don't see the big rip. I think that markets are fully pricing in this part, which is the free money. I mean, David Tepper came out last week or 2 weeks ago and said, I bullish you was the market because, again, for a guy like that, a billionaire, he gets to take advantage of all this money. He can borrow tons of money knowing that he's going to create, 8, 10, 12% off of it. So if I'm borrowing it 2 or 3, I'm making 8 to 10. It's a pretty good herb. And I think that's where, so I think the markets are basically fully priced. However, they can still go higher. And I would never try to pick a top or tell you that it's over, but I think the days of the rip are over. I think, again, in my opinion, the next big move will be down, but it doesn't mean we can't go up another 30 or 40% before that happens. There's no way to end a market. It's like I'll give you one more quick trading story if you got time.
Yeah.
In the 90s, my partner and I, we knew that the tech was ridiculous. That prices were ridiculous. Okay. But we were so short, okay, that we had to make a decision. Either we go out of take a chance in going out of business, or we choke it down, take our losses, and stay in business. So of course we had to choke it. We decided to choke it down and just take our losses. And of course, 8 months later, whatever it was, bang, it was all over. Okay. And we would have made a fortune. But again, this is where you have to have the self-control and the discipline to cut your losses and never put yourself out of business. Because the one thing we know about being an investor or a trader, your inventory is your capital. And if you got no capital, you got no inventory, you got no business. So that's that's my advice to everybody.
That's I've actually never heard anyone put it that way. That's interesting. So let's wrap it up here. March Madness. Who are you cheering for, and who do you got winning it?
Well, I'm betting first of all. Okay, so that's number one. I mean, I'm hoping. I would like to see Gonzaga win it. I know they're the prohibitive favorite this year, but I've been watching them before they were a big time school and they were a little school. I thought Michigan had a great shot, but the injury is probably going to hurt them unless they can survive the first 2 rounds. And believe it or not, Illinois has got a pretty good shot. I don't think there's a lot of real dark horses here that are going to go far. Now, there will be some upsets early, but I think when it comes down to it, I think it's going to be a pretty chalky tournament, especially without the fans cheering on the underdogs, because one of the big things of March Madness in history is when you have all these fans that are cheering you on, okay, and they always go for the underdog. You don't have that extra boost anymore. So I think this will hold much truer to form after some initial upsets, probably today and tomorrow.
Okay, well, Bubba, thank you so much for coming on. This was a great way to spend my Friday afternoon. I appreciate you taking the time and being so generous with your time, chatting some stories about trading and helping us sort of think about these macro factors that surround the small cap and micro caps that we generally cover. And I hope in the future you'll come back on and
I would love to come back anytime you want me. I would love to come and hang out with you guys. I had a ball. I enjoyed it. And, it's always a pleasure to talk to people that have an understanding of actual markets and aren't just newscasters that have no freaking clue, okay, of what's going on, which is more often the case out there. And I love that what you guys do. And I think you taught me something that I personally won't be able to do it because, I'm not a social media guy, but I got news for you. I got people that will learn how to read that because I think I thought it was a great point you made.
Yeah, well, I wouldn't say how much of an understanding we have. We're trying to have an understanding. We're trying to think about those things.
Look, I think you taught me something. And, listen, one thing about me, 43 years I've done this, I'm still trying to learn more. I've always been my own investor. I've only traded my own money for 43 years. So, I mean, I always look to learn more because whatever I can use to take an advantage of a market. And I think that's a great point. So again, I'm going to, next time you have me on, I'll report on how we did with it and how it helped me or didn't help me, but I'll give you a straight up story. Cause me, I'm going to tell it like I think it.
Awesome. Well, thanks so much for taking the time to join us today.
Thank you. I appreciate it. It's great to be on.
Jay, I see that you logged back in. Any updates?
Any updates? What kind of update you looking for?
Child, apologies if you didn't want that out there.
No, I'm fairly open, as most people know by now. Nothing yet. That's why I'm still sitting at this desk here. I'm in town, and that's why I haven't been on live the last 2 days, for those of you that actually care to know. But yeah, so it's a waiting game. Hopefully I'm back at the desk by Monday. I'm sure my wife would love that as well.
And how many articles have you published since you thought your wife was going into labor?
I think we're about a 12-ish. That's all right.
I
always work.
I said that yesterday. Scott Patterson had to go find a cord for his laptop, and I was like, "Oh, maybe I'll talk about why Jay isn't here." And I said, "This guy's so addicted to work that it'll probably hardly slow down his production."
Yeah, I've already told my wife I'll have my laptop in the delivery room as well as the post room, and her condition is I can't be on the phone.
Well, that's pretty reasonable. So are there any stories over the weekend that are coming out that we should give a little bit of a teaser on?
Well, I've got kids making noise in the background here, so I won't be long. But we've got a number of YouTube videos that will be going out. I'm pretty well looking to get anything that was filmed in February out the door this weekend because I don't want it to be stale for our viewers. On top of that, both Jim and Brayden have some great content, and we've got some earnings reviews from Sundial and GTI that some of it might go out late tonight yet, but it'll certainly be over the course of the weekend here. Okay,
well, there's I don't really feel like getting into the news. Bubba was really fun to talk to, so I just wanted to go the full hour. That's pretty much it. I mean, Payfair went public. Maybe we can get something up on that. An interesting TSX IPO tech. Whenever we get legitimate, real small cap companies listed in Canada, I generally like to talk about those and focus on those. And the SLR stuff, we just got that news, so let's see how that plays out this afternoon. For our audience, I'd like to give a disclaimer. I don't think we've actually talked about any names, but just in case you get the sense that we did, nothing we talk about here is a buy or sell recommendation. We are not licensed financial advisors. This is for entertainment and informational purposes only. If you're looking for financial advice, I suggest you go find somebody who is licensed, not somebody like myself or Jay. You could have spent your last hour staring at any screen, any place in the world. You chose to spend it with us. I sincerely appreciate that. I hope everybody has a fantastic weekend, and we will be back Monday at noon. All right. Thanks, everybody.